Here is a number that should not be possible. Over the last 3 years, Cresco Labs lost $253 million before taxes and was charged $127 million in income tax on those losses. Nobody on Wall Street covers this stock. Today, we are. This is RoboSystems, initiating coverage on Cresco Labs, ticker CRLBF. Start with the top line, because it is falling. Revenue peaked at $843 million in 2022 and has declined 3 straight years, down to $656 million in fiscal 2025. Some of that was deliberate. Cresco exited California and absorbed a new Michigan excise tax. Most of it is wholesale price deflation across mature markets. First quarter revenue was $151 million, which management calls the baseline, with the second quarter guided up roughly 10% from there. Now the part that makes Cresco interesting. While revenue fell, margins went up. Adjusted gross margin hit 50.7% in the first quarter. Adjusted EBITDA was $157 million last year, a 24% margin, best in class at this scale. The engine is productivity. Sunnyside dispensaries generate about 30% more revenue per store than the average store in their markets. And Cresco holds the #1 branded share in Illinois, Pennsylvania, and Massachusetts. Above the tax line, this is the sector's most disciplined operator. Below the tax line is a different story. Section 280E bars cannabis companies from deducting normal business expenses because marijuana sits in Schedule 1. The result? From 2023 through 2025, Cresco was charged $127 million of income tax on $253 million of pre-tax losses. Last year's effective tax rate was negative 47%. Taxed on losses. That is the single biggest reason this company reports red ink. Here is what almost nobody prices in. Cresco, like several large operators, largely stopped paying the disputed portion of those taxes. The reserve for unrecognized tax benefits, the IOU if the IRS wins, grew from $19 million at the end of 2023 to $201 million in 2024 to $239 million at the end of last year, plus $10 million of penalties and interest accrued in 2025 alone. That reserve now equals more than 60% of Cresco's entire market cap. And now the switch is flipping. Since April, state-licensed medical cannabis is Schedule 3 and Section 280E no longer applies to medical activity, roughly half of Cresco's revenue. The hearing on rescheduling all marijuana wrapped up on July 15th, and the record now goes to the Drug Enforcement Administration's judge. If the broad order lands, run the pro forma. $157 million of adjusted EBITDA, less depreciation and interest, taxed at a normal rate, is roughly $40 million of normalized earnings. At today's price, that is about 10 times adjusted earnings. Cash flow tells you the business underneath is real. Despite a $140 million GAAP net loss last year, $105 million of it non-cash impairments, operating cash flow was positive $73 million and free cash flow positive $38 million. One honest caveat. Part of that cash exists because Cresco is not paying the disputed taxes. Adjust for the $47 million reserve build, and underlying free cash flow is roughly break even. Both things are true. The operations generate cash, and the tax dispute flatters it. The growth options are unusually cheap. Pennsylvania is the big one. Cresco is the state's #1 wholesaler, and now its largest retailer with 27 stores, in a medical-only state where adult use keeps stalling but keeps getting closer. Kentucky had its first harvest in April. Texas awarded Cresco one of only 15 vertically integrated medical licenses in a state of 31 million people. And this November, the federal hemp ban pushes intoxicating hemp demand into licensed dispensaries, exactly how Illinois, Cresco's home market, wrote its law. Now the bear case, and it is concrete. $574 million of total debt and leases against $67 million of cash. The anchor is a $325 million term loan at 12.5%, due 2030. Interest consumed $51 million of cash last year, nearly 8 cents of every revenue dollar, before the IRS gets a word in. Stack the tax reserve on top, and roughly $750 million of claims sit ahead of a $390 million equity ticket. So, what is it worth? These are implied values under stated assumptions, not price targets. Base case, where broad rescheduling stalls and the back taxes get enforced, roughly 25 to 50 cents implied. Broad schedule 3 case, with normal cash taxes and cheaper debt, 70 cents to $1.10. And if it ever re-rates like a normal consumer products business at 10 to 14 times, EBITDA, $1.60 to $2.90, even after deducting the full back tax bill. Today's 77 cents says the market half believes the catalyst and gives zero credit for the re-rate. The framework. Bulls own the sector's best margin discipline, a locked and loaded Pennsylvania, medical tax relief already flowing, and the most tax talk in Tier 1. Bears own a shrinking top line, 12.5% debt, a $239 million tax IOU the IRS is fighting to collect, a pending appeals court challenge that could reset Schedule 3 entirely, and an Ohio antitrust suit. Watch 4 things: the judge's recommendation, the court's stay ruling, the August 6th earnings report, and that tax reserve, in either direction. This entire analysis was built using RoboSystems, an open-source platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. You can set up the same tools I just used in about 5 minutes. Head to robosystems.ai to get started. Link in the description.